Hey everybody, I'm Michael Wagner, one of the co-founders here at Omnia Family Wealth. And I want to thank you for taking a little bit of time out of your day to spend with me to learn about bonds or fixed income and the role they play in your portfolio. So, for the last 30 or 40 years, we've been in a declining interest rate environment. And there's an inverse relationship between interest rates and bond prices. So, as interest rates have continued to come down, you've had wins at the back of bond prices. Bonds have been worth a little more each day as interest rates have continued to fall. Now, interest rates move in 30-year cycles, and we are past due to be entering into a rising interest rate environment. And that is some cause for concern. Remember that traditionally, bonds have been the source of stability in people's portfolios, but that goes out the window when you have a rising interest rate environment, because those tailwinds for pricing suddenly become headwinds, and every day bond prices are under pressure when you're in a rising interest rate environment. It then becomes very difficult for bonds to be that source of stability for your portfolio value if every day, due to the rate environment, they're worth a little bit less than the day before. So what do? What can you have in your portfolio that, regardless of interest rates or what goes on in the stock market, will be a source of stability for you? Now, here at Omnia, we have a lot of tools at our disposal, but a couple of things come right to my mind. The first is to build out a sleeve of very high quality hedge funds that have very low beta or sensitivity to the price of the stock market. Building out a high quality sleeve of low beta hedge funds can do much of what bonds have traditionally done for you. We're not looking for hedge funds that are going to consistently knock it out of the park, and we're certainly not looking to do that with the sleeve overall. But what we are looking for is an element of boring is beautiful. You want consistency and stability in your returns, very similar to what bonds may have done for you 20 years ago. You want that piece of your portfolio that is going to be stable, potentially even worth a little more, regardless of what's going on in the stock and bond markets. And true hedge funds are a great way to add that sort of role to your portfolio. So that's one thought. The other thought that we have is lending money to real estate in a very secured and high in the capital structure way. So you're making senior secured loans to performing real estate that, by the way, is paying you a floating rate. So yes, it is fixed income in a sense, but that floating rate element brings a whole new level of stability in a rising interest rate environment. So in a rising interest rate environment, as rates go up, these bonds will pay you more because that's how they're structured. They even, in some cases, have rate floors. So you know the minimum they'll pay. But the idea, again, is really to have a stable source of income in your portfolio. And that is a great place for senior loans to commercial real estate that pay a floating rate. So, bonds on their own are not going to be able to do for your portfolio what they were able to do in past corrections and crises. We're entering into a rising rate environment, and we've got to get creative about the players in your portfolio and the roles that they're playing. So I've given you a couple examples of the things that Omnia is doing to protect portfolios in a rising interest rate environment. Now, I always want you to consider the source. Know what you're looking at, know what you're reading. Be mindful of the things that are in your portfolio and why they're in your portfolio. Please feel free to reach out to me, give me a call, shoot me an email. I really love hearing from you. I'm looking forward to it. I hope you have a great day. I hope you learned something today. And as always, please remember to consider the source. Thank you so much. Take care.